Now this is a problem. Warren Buffett finally gives us his honest look about the U.S. debt. What many people do not realize is that the U.S. debt might very well not be repaid, because it would simply be impossible over time. There are two curves here. This curve is the 10-year average GDP growth rate. It shows how strong the economy has been over long periods. In the late 70s and 80s, that number was high, around 8 to 10%. Over time, it steadily declines, and today, it's closer to roughly 2%. The blue area is total U.S. federal debt, which has risen exponentially, accelerating sharply after 2008 crisis and especially after 2020 COVID crisis, reaching around $38.5 trillion and obviously projected much higher from now. Warren Buffett has mostly ignored such macro analysis and focused on the internal factors of specific businesses. But in recent years, he's been more open about major economic topic, the scale of U.S. debt and deficits. Buffett believes that the U.S. national debt, which is now around $38.5 trillion, is getting unsustainable. That debt is financed by issuing treasury bonds that are bought by investors, institutions, and governments. The key dynamic is pretty simple. When growth was strong, the economy didn't rely heavily on debt. As growth weakened over the decades, more debt was used to support spending and keep the economy moving. But as we know, that debt did not restore the earlier high growth rates. It only stabilized things at lower levels. So we end up with a clear and painful pattern. Strong growth with low debt in the past, and now much higher debt alongside much weaker growth. We're now operating with fiscal deficit that's unsustainable, Buffett says. Each year, the government runs either a deficit or a surplus. In simple terms, it's just money in versus money out. For fiscal year 2025, the U.S. collected about $5.23 trillion in revenue, but spent around $7 trillion. That gap, about $1.78 trillion, is the deficit for that year. A surplus would be the opposite situation, where the government collects more than it spends, and the important point is what happens next. That deficit doesn't disappear. It gets added to the total national debt. So when you see the $38.5 trillion number, it's basically the accumulation of many years of deficits stacking on top of each other. You can see that for roughly the past 25 years, the U.S. has run a deficit almost every single year. There's no real reset, just continuous accumulation. On this chart, the dark blue line is the 10-year Treasury rate, which basically the cost of long-term borrowing. You can see that historically it used to sit much higher, 5% to plus 10% in earlier decades, like in the 1970s. So even though the current 4% today feels high compared to the near-zero period after 2008, in this longer-term context it's still actually a pretty low cost of borrowing. And when you look at this part, the biggest tempo of growth of the U.S. debt came when the government needed to fight recession. Crisis of poor growth and unemployment also brings a need to pump money into economy to grease the wheels of the entire economic machine. The important part is how everything connects. When rates were higher in the past, debt levels were much lower. Today, even moderate rates like 4% have a big impact because they're applied to a much larger debt base. So the issue isn't just the rate itself, it's the combination of rate multiplied by total debt. That's why even a small increase in bond yields now has a much bigger impact on interest costs than it would have decades ago. Another factor is that the U.S. debt is denominated in its own currency, the dollar. That hypothetically means the Federal Reserve can create new money. In theory, the Fed could print large amounts of money and use it to buy U.S. treasuries, which would push down yields and effectively make the debt easier to finance. Not literally erase it, but reduce the burden. But this comes with major consequences. Creating a large amount of new money increases the money supply in the system. If that increase isn't matched by real growth in goods and services, it puts upward pressure on prices. In other words, inflation. More dollars in circulation means more spending, and if supply doesn't keep up, companies respond by raising prices. Since 2020, the Consumer Price Index, basically a basket of everyday goods, has risen by more than 25%. That's the outcome people actually feel, prices going up across the board. Another key idea is that the U.S. dollar is the world's reserve currency. That means countries, central banks, and global trade rely heavily on it. There's constant demand for dollars. Now, if too much money is printed, it can weaken the dollar and reduce trust over time. And once trust starts going, that's a problem. But replacing it? That's extremely hard. Warren Buffett has said there's no real alternative right now. Because the U.S. issues debt in its own currency, it's unlikely to default. It can always create more dollars. The trade-off is inflation and potential loss of confidence, not a clean escape. So the idea is simple: grow the GDP base. The way out isn't just cutting or borrowing, it's getting real growth going. If productivity rises, businesses become more efficient, they expand, wages go up, and that naturally increases the tax base, from both individuals and companies. So instead of relying on debt, the system starts supporting itself. And that comes down to two key things: spending money in a way that actually improves productivity, and setting tax rates at levels that don't choke growth but still generate enough revenue. None of the information provided should be considered financial advice or investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glinius.